We would like to acknowledge the traditional territories of the people of the Treaty 7 region in southern Alberta, which includes the Blackfoot Confederacy, comprising the Siksika, Piikani, and Kainai First Nations, as well as the Tsuut'ina First Nation and the Stoney Nakoda, including the Chiniki, Bearspaw, and Wesley First Nations. The City of Calgary is also home to Métis Nation of Alberta, Region 3.
Hey everyone, welcome to another great start to a webinar series on behalf of the School of Public Policy at the University of Calgary. I'm very excited to lead you in today's webinar. My name is Kara Oosterhuis. I am a reporter with RealAgriculture, and as I said, I will be hosting today's webinar. Thank you all for joining us. The School of Public Policy is Canada's leading policy school known for our practical research. Just some quick housekeeping notes. If you have to leave early, recordings of the webinars are posted on the School of Public Policy website, and you will receive a link in the follow-up email. So no worries if, like I said, if you have to leave early, you will be able to still catch this. Please, for those of you that are watching live, though, the beauty of live is being able to bring all your questions in and have them answered in real time. So please type your questions in the Q&A box below, and we will pose them to our speakers. Of course, we only have so much time, but we will pose them to our speakers after the discussion, which is the Q&A portion. Today's panel discussion will be on connecting Canadian farmers to Southeast Asia markets now and in the future. And today's panelists, I'm very excited to introduce them, are Dr. Derek Bruin, Department Agribusiness and Ag Economics at the University of Manitoba, Mark Hemes, who's the president of Quorum Corporation, and Dr. Richard Gray, who is a professor, Canadian Grain Policy Research Chair, Board of Directors of the Canadian Agricultural Policy Institute. Before I get them in here and we dive into it, I'm going to give a little context before we get into the discussion. Canada's agriculture and agri-food export growth has been remarkable. Similar to the US, the historical development of the Canadian grain handling transportation system was part of a nation-building process to encourage Western settlement by providing farmers with a transportation system to enable movement of their grain to either the West Coast or through the Great Lakes. Canada exports 75% of its wheat and 90% of its canola production, in addition to a host of other grain and agri-food products. Today, Canada's biggest markets include India, China, and other countries in Southeast Asia, representing large opportunities for future growth. Over the last 10 years, Canada's agriculture and agri-food exports have more than doubled. These products leave Canada through our major ports. For example, the Port of Vancouver handled 147 million tons of cargo in 2018, with 27 million tons of that grain being exported. This growth has occurred with a system that initially had the crow rate imposed for many years and now has a system of maximum revenue entitlement, also known as MRE, imposed on the two major rail companies within Western Canada through the Canada Transportation Act. So our discussion today will analyze and discuss our growing grain export sector and how it may be bottlenecked by our current rail transport system. With recent years of competition on the major rail lines with other productions such as oil, we will discuss the effectiveness of the MRE system in encouraging efficiency, enhancing investment, and technological improvements by industry and the grain industry as a captive shipper. We will also touch upon the products upon which MRE does not apply and resulting market distortions seen through the years, and our panel will offer some policy concepts that could improve efficiencies and capacities of our current grain transportation industry, effectively removing some barriers to growth. The growth of Canada's grain industry has been successful by any measure. Population growth in the West since the 1900s, wheat production and export growth as two markers. Has the system been efficient, and how is it set for the future as Canada continues to target future global market demand for its grain products? The proposed structure of the webinar right now today is going to be approximately 5 to 10 minutes as I go through each speaker, and we will get right into it. So today, to lead off the discussion is Mark. Mark, how is it going today? Oh, Mark, I believe you are still on mute. So yeah, there you go.
Thanks a lot, Kara. Yeah, I'm gonna start off the presentation today just give some introductory comments about some of the performance issues and the volumes. Can you see my screen now?
You bet, Mark. It all looks good to me.
Okay, just pop that out into. So the growth over the last, say, 40 years that we've seen in the grain handling and transportation system is pretty significant. And the rate of growth is probably one of the things that is more prevalent to this discussion. We've been monitoring the grain handling and the transportation system for the last 20 years. And in the first 10 to 15, the average annual growth was anywhere between 1.5% and 2%. And as you can see in this graph, as you go through that period of time, these last 10 years have been the most significant, where we've seen an average of 4.5% annual growth every year. In most terms, people are thinking about the fact that it's going to average out at about 3% annual growth. The total grain supply is something that, as the grain monitor, that we're most interested in looking at, and that basically represents the amount of total grain in any given crop year is available for the movement and sale. And if you take a look at this graph, just over the last 20 years, it has grown significantly. In the last 8 years, we're averaging about 81 million metric tons per year. If we continue at the growth rate that we've seen in the last 10, we're easily going to surpass 100 million metric tons in grain supply by the time we get to 2030. Another point, and because we're talking about Asia movements, if you went back into the early 80s, the big buyer of Canadian grain was the former Soviet Union, the Eastern Bloc countries, and into Europe. And the vast majority of that was being pushed through the eastern ports, Thunder Bay in particular. But as you see in the last 15 years, that's changed significantly. The former Soviet Union and the Eastern Bloc countries in Europe have basically become more self-sufficient. But Southeast Asia and the Asia Pacific countries, as well as Central and South America, have become big customers. And that flow of traffic is going off the West Coast. And that's why we've seen so much capital investment going into West Coast ports to handle that growth in business. Vancouver and Prince Rupert's volumes have essentially doubled and tripled in that period of time. So if you look at what the elevator network looked like in the country back in 1980, there was almost 3,500 grain elevators, most of them the old wooden crib elevators that everybody sees in the nice paintings of the prairies. That changed significantly starting in about 1986, where they started to rationalize the rail network, and the number of elevators decreased significantly to the point where we've been holding at about 400 elevators out in the country on average. But the most significant thing is that during that period of time, as the country elevator network evolved, we went from those small little elevators to the high throughputs, and now most recently loop track facilities, where each one of them has got anywhere between 20 and 40,000 tons worth of capacity. So all in all, we have seen a resurgence in the amount of capacity that the country elevator system can handle, just in fewer elevators. Another thing that's happened, especially in the last 20 years, is the railways have really adjusted the way that they move trains. Back in the early 80s and late 90s, we started to see this movement from picking up 10 and 15 cars per elevator to where we're now seeing almost 85% of all of the grain that moves out leaves elevators in 100-car blocks or a train that's over a mile long. And that has really improved the efficiency of the grain handling and transportation system. And it's really been a boon to the efforts that have gone on in accommodating the kind of growth that we've seen in the industry. Another thing that's really interesting and prevalent is if you went back into the early part of this century and into the late 1990s, the average vessel leaving the West Coast or Canada for that matter was weighing out at about 28 to 30,000 tons per vessel. But in the last few years, we've seen that increase significantly to the point where the average vessel weighs out at over 50,000 tons. And that's another big significant change in what we've seen. So how has the system grown in the last little while to accommodate that kind of growth? Well, this graph is a very, very high summary of a lot of analysis that we've done together with grain companies through the WGEA, which is the Western Grain Elevator Association, to take a look at what is the available capacity for the system. Now that takes into account what the country elevator system can process, as well as what the port terminal elevator system can process. And as we look at that, the blue bars here represent what's happening on the West Coast, and the green is the whole system. And as you can see, as we grow to that point 10 years out, the West Coast is going to get a little bit tight as we get to the end of this decade, but as a system, the system has got more than enough capacity to handle it. Probably the big question is can the railways move that traffic? My last slide here is just to make a point about why is grain different? Grain gets handled in both a policy, a regulatory, and an operating fashion than most any other commodity that's out there. And there's certainly a lot of reasons for that to happen, but one of the primary reasons is that the grain supply chain is considerably different in how it works. If you take a generic supply chain model that you would apply to television sets, clothing, furniture, or automobiles, essentially the person who, or the entity that produces that product has very distinct control over almost the entire supply chain all the way to the end user, both in how the financial part of the system works, as well as how the relationships between all those parties happen. It's significantly different for the grain industry because the individual or the entity that's producing the product is the farmer in the prairies. And his or her only relationship is with the grain company in the country that they're selling their grain to. The second part of that is that producers are price takers. They don't set the price at which their product is sold. Therefore, anything that happens any further down the supply chain, any additional or incremental costs that are associated with that flows back through the supply chain and it lands in the lap of the producer. So because you've got that kind of supply chain relationship, there has to be some form of regulatory protection in place in order to protect them from any kind of price gouging that might happen down the supply chain that's going to end up being passed back to them. And that's my introduction to this. I'll turn it back to you, Kara.
Thank you, Mark. So that was a terrific presentation and a great overview. Next, we're going to jump into Dr. Derek Bruin, and as he said, he's a Department of Agribusiness and Ag Economics at the University of Manitoba. Derek, I believe, has some slides for you as well, so he'll be presenting right now.
Hi, yes, and thanks for having me. And before I go into the slides, I do want to say our policy in rail and some of the growth that Mark identified there has to do with policy that don't really have that much to do with rail. Sorry, my I'm rolling forward, but can't go back. Here we go. So there was policies that led to, good research that led to lots of production. And I think one of the big reasons for the production jump at the end of the production side that Mark was pointing out was there was just higher grain prices, and so you can afford more inputs, and we've had bigger yields. So that's part of what happened. And then there was private incentives on the canola side in plant breeding that led to lots of production. So there's lots of policies that had an impact on the growth at the farm level. And now the concern is, do we have it right in terms of the policy regarding moving it and the railways? So one of the key things is that the railway and even the grain handling firms, the grain companies, have these network economies. So that leads to firm concentration, and they can get price gouging. So I wanted to just flag that point, that there are these economies in scale of scale and network firms. So we only have two major railways, so we only two major firms there, and in some parts of the prairie collection system, they're seriously monopolies. And then there's quite a lot of concentration in the grain handling sector, both in collecting it from the country and then in the elevators, or sort of the terminal elevators that are taking off railway cars and putting onto the boats. There's more there, but I'll skip forward just to geek out a little bit on the economic side. For those of you who do follow the economics, we always have a graph. This is the supply function, and in the world of grain handling, this world price, that's those boats in Vancouver, that's what we're trying to capture the most of. And if we have a very competitive system, that the supply is meeting the cost of moving that grain to the world market. So this world market's a Vancouver price. The farmer only gets that Vancouver price minus the cost of moving it through the system. We'll get the most production from the farmer the more we reflect of that. So we will keep those big quantities moving if we get a relatively close basis between the world price and what the farmer pays. If we had a very competitive systems, that's where we would go. If we had a perfect monopoly, even though the monopoly would be, as they decrease the quantity that's going through the system, they do actually increase their cost. They could still make profits by setting their marginal outlay. That's something that you get from economics, but they set it equal to those costs. And they actually make more profit with less quantity moving through the system. This is the concern with bottlenecks, is sometimes slowing down the system and decreasing the quantity that's moving through the system is profitable for somebody in the system. We don't want it to be the railways that are profitable because of that. And so in the past, we've set their rates, and we've set their rates at some level, a lot less than what the monopolies were, but it's never been exactly zero return. It might have been in the history of the crow rate when they were set in the 1800s and stayed that way till World War II, that they might not have been getting fair compensation. I do want to go through sort of a history of the policies we've had. So, back in the 1800s, we had fixed rates, and the idea was to fix those rates so that we were not gouging, but the railways were getting some fair return. But we got the rates so low and such a long time without incentive that when the United States started to deregulate their railways, we saw how much there was in terms of investment in railways and improve the efficiency of the delivery of lots of products through deregulation, that Canada really looked at deregulation too. And so one of the reasons that we saw the big elevator drops in the 80s was that they realized that they had to allow the railways to give incentives to the grain companies to set up more efficient elevation systems for the railways, okay? And that things changed around through that. There was still subsidies to farmers in terms of their railway movements. They converted the crow rate into a subsidy so that at least the railways were getting fair compensation for their costs. And then in 2000, at the sort of the beginning when Mark starts to collect data, it's sort of linked to the regulation of the MRE. The MRE becomes imposed. And the MRE is an average cap, but it did give them lots of flexibility to offer incentives to the grain companies for more efficient moves, even more than they had in the 80s. And so we saw a lot of change because of that. And there was big concerns in 2013 and 14 that there were problems. There was a glut there, and there was a big review, and they looked at some other legislation, but they kept the MRE. After looking at all that information, even through a fairly rough period of 2013 and 14, they did keep the MRE in. But the one thing that they did change, one of the parts of the MRE to split the incentives for the CN and CP to make their own capital investments. So for me, the most recent policy that's been applied to the grain handling movements, the MRE, and then the tweak of the MRE to adjust the capital investments, those have been very much improving the efficiency of our supply chain. Those things have been very good in terms of giving the incentive to the railways. The more Q that they move under the MRE, the more profits they make. So there's an incentive with the railways to move as much grain as possible. And there was even in the last bill in 2018, there was incentive for them to expand some of their capacity. But just to show you, Mark listed some of this stuff, but I wanted to touch base on some of the effects that happen through the MRE. It is not a revenue cap, just to clarify. It's a revenue limit on the average ton moved. But remember that if you move more and more tons, your costs are actually going down. So you're making more profits, the more tons you move, just because of the fact you're saving costs. So there's an incentive within the current structure to move as much grain as possible. At least it is to the railways. And to some extent, the railways can police the grain companies because they do have a bigger, they're more concentrated. They have more pull in the supply chain than the grain companies do. And you can see, we have seen big improvements. Lots of farmers who don't have their local elevator don't see the reduction in the elevator as an efficiency gain. But in terms of grain movement, it did lead to collection of cars in a less costly way. And so it did lead to more efficient movements to the railways. And you can see the turnover ratios especially. These are showing that the elevator fixed costs are becoming more and more efficient, both at the terminal and in the prairie elevators. So since the MRE was put in 2000, we've seen big increases in the efficiency of the supply chain. So for me, a policy that has affected the efficiency of the supply chain, the MRE is kind of a wonderful piece of legislation. Like for me, it was a really good way to respond. I think sometimes when we look at market failures, the fix is worse than the problem. The cure is worse than the original problem. And I don't think that's the case with the MRE. I think the MRE has actually really helped us get ready to move a lot of grain into Southeast Asia. And I'll just touch on one last thing. When the MRE was adjusted in 2018, they did split the fixed costs so that the CP and CN could be compensated for their own internal investments. And I think that was a very important tweak to the MRE that's only happened it's really only been in place since 2018, so we haven't seen all of it yet. I'm listing the high efficiency cars that CPR and CN have purchased already, but both of them have goals for, I think CN's got goals around 6,000 as well, but CPR has said that they're going to put 5,900 high efficiency grain cars on the line. That further increases their efficiency so that they can move more. It also lowers their cost. And within the MRE, they're getting an incentive in the MRE to make that investment. So they're getting a little bit more revenue as well. So overall, the incentive for the railways is to keep that system as efficient as possible. So in terms of a policy response, I think the MRE is one of the best policy responses that's ever come up in the history of regulating Canadian grain transportation. So I'll stop there, but that's my bit.
Thank you very much, Derek. Before we hop into Dr. Richard Gray here, I'm just going to quickly remind you, I am seeing your questions coming in right now. We'll get to them right after Dr. Richard Gray's presentation here. So thank you very much for submitting them and keep them coming in. We will answer them right away here soon. And Richard, if you'd like to take it away, you absolutely can.
Okay, Derek, I think you might, oh, here we go. Well, thank you, Kara. It's a real pleasure to be here, and thank you to the Simpson Center for the invitation. I don't have a lot to add to two excellent presentations, but I will provide a little bit more commentary. I'll just briefly share my screen here and get this slide view. I just wanted to emphasize a couple of things. One was that this remarkable increase in grain production in Western Canada, I think is a real established trend. It's not a trend that's likely to go away anytime soon. And that 4.5% growth rate, that I don't see any reason to think that's going to drop off anytime soon. Varieties continue to improve, agronomics continue to improve, and frankly, the farms are profitable enough that they've been investing in the inputs they need to, and with an uptick in prices, I think we could see this continue. Obviously, there's possibility of a drought, but there's also the possibility of a bumper year like 2014 again. When that 2014 came along, people were saying that's an anomaly, that won't happen again. And yet we were very close to that this past year, despite fairly ordinary weather. So I think this trend is going to continue. Just re-emphasizing, the growth in West Coast has been faster than the growth in production because that's where the markets are. So we've seen phenomenal growth of about 6% per year in West Coast exports. And I guess looking at the system capacity, I'm not quite as confident that we have the capacity that we're going to meet that future demand. I think there's going to be pressure on that, and we need to think about that very carefully. This graph was written after that 2014 large crop in Western Canada. And it shows the difference between the farm price and the West Coast price of grains in Western Canada. And so prior to 2014, we had lots of capacity or enough capacity in the system. I'm just bouncing back and forth, sorry about that. The export base was about $70 a ton. It went all the way to $250 a ton at a peak in 2014. And then slowly as the system got adjusted, caught up with that supply, that basis came down. So any shocks in demand, which the system can't meet, which could be a very large production year, or any disruptions in that supply chain can have big impacts on producers. And of course, that impacts their future ability to grow grains as well. This past year actually was a phenomenal year. This is monthly movements. The red line is 2020, and you can see it's well above the 2019 levels, which were a pretty good year, and and almost 20% above where we were in 2019. Sorry, the 5-year average. So this has been an incredibly good year for grain exports and grain movements. I just wanted to point out, though, that for total rail movements, it wasn't a particularly good year. In fact, total rail movement was down. So to some extent, the railways had additional flexibility to move grain because other commodities weren't moving as well. They had additional crews and locomotives that could be diverted to grain if they needed it. I'm not suggesting that it would have been a crisis without it, but I'm saying that helped the railways meet this surge in grain demand, and we've resulted in record grain shipments this year. But this reality is probably going to change. If you look near the end of this, near the end, you can see that the total rail capacity or use has gone up, and we no longer see this anomaly for grain. Just a couple of things. I agree with Derek. I would also say, because the RMRE is not being updated to reflect rail productivity gains, the railways are paid pretty well right now to move grain, which I think is a win-win for all participants, because there's a lot of incentives for increasing that capacity. And we've seen some recent investments that have allowed the system to really expand capacity over the last few years. I do worry a little bit that railways are naturally going to be conservative in their capacity planning. They don't want to have resources that are stranded. And for them, it doesn't really matter whether the grain moves in September when it's harvested or the following July or even perhaps after that. So the railways are typically conservative in their plans with the objective of minimizing costs. I think the MRE could be tweaked a little bit to actually improve that, increase that incentives even further. And I guess those are my opening comments. Kara, I'll turn it back to you.
Hey, thank you very much. Thank you to all three of you for your presentations. We do have some questions coming in here, so that's always great to see. Keep them coming. We still definitely have some more time. If I can get you all three of you to get your cameras back on and get back ready to answer some questions, that would be terrific. The first question that is coming in here says, does the maximum revenue entitlement hinder private sector investment in the grain transportation sector because of the revenue cap doesn't recognize costs in its index? And of course, with the exception of hoppers. Does anyone have any comments on that?
I can speak to it first. I'm sure that Derek and Richard have some thoughts on this, but I would take sort of exception to that, because when you look at the way that the VRCPI is calculated, that gives the railways the rate adjustment, it takes into account almost 30 different cost factors, everything from car repair to the cost of fuel to the cost of pension plans. So all of those costs are actually indexed into the calculation that gives them their annual rate increase. So I don't think that it acts as a disincentive. And in fact, when you include some of the costs that they're allowed to include, such as the car costs, and they also have a section that covers any kind of industrial development or plant improvements that can be attributed directly to grain. Those costs are also included in the VRCPI. So it actually probably goes the opposite way. It acts as an incentive for them to invest. The one thing about the MRE is that it is a disincentive to try and gouge on price. It allows them to keep their productivity improvement, anything that they get from that, and it only allows them to increase their rates by the rate of inflation that is associated with any of those cost factors.
Does anyone else care to add anything to that?
Yeah, I think the question doesn't really take into account the 2018 changes. Like, there was an expansion in what could be used as costs, and those, if you look, it's billions of dollars of investment that have happened since 2018. So the MRE really changed in 2018. And prior to that, the MRE limiting the wedge that can be taken out of the farmer's price versus the export price leaves all that money on the table for the grain companies to invest. And look at what they've done in terms of expansion of their prairie elevators are all they've expanded their capacity, even though there's less of them, and their terminal elevators in Vancouver have all expanded. So our total capacity since 2000 has really increased as well.
I guess I just add that, if you look at the evidence of investment just generally right through the supply chain, you've seen a massive, if you like, a modern industry that's been brought about by private industry within this regulatory framework. So if it was a detriment, I don't think you would have seen the same kind of modernization that's actually taken place. And I would also add that when it comes to railways in the world, Canada should be fairly proud about the efficiency of the railways and how they can move grain for fairly low costs. And I think that's, again, part of the MRE framework has changed the incentives, so the railways have an incentive to move grain, a lot of grain quickly, and they'll get enough return on the investment if they do that.
Thank you for your comments. Next question coming in here says, when a train derails on the way to the port and all the 100 rail cars are all scrapped, what compensation does the producer or the grain company sending the grain to port receive? Do we know what percentage of the grain moving to the ports is derailed and or not delivered?
I can speak to that. I would, and this is off the top of my head, but basically we look at all of the tonnage that moves, both from the country and what arrives at the destination and the port. And I would say that less than 0.25%, maybe even less than that, actually gets lost in derailments. Derailments become big issues because the media will pick up when it happens, but it doesn't ever pick up all of the other stuff that moves. So the vast majority of it is it's so minuscule, the amount that derails or gets lost, that it's really not even a consideration. But when it does happen, the railways will compensate the beneficial owner of the product that gets damaged based on whatever their value is that they attribute to the product that gets lost. And they can do that through their insurance, but most of them are self-insured. When it comes to the rail cars themselves, again, the railway that the derailment happened on will compensate whoever the beneficial owner is of the equipment that is damaged, whether it's a total write-off or whatever it costs to fix it. Again, we have a very, very safe railway network in Canada, and while derailments and the like get a lot of publicity when they happen, it gets that publicity because it doesn't happen very often.
Okay, thank you for your comments. We'll go into the next question here. What effect has the Cptpp had on exports to Southeast Asia in general? And are there specific commodities and markets that are seeing the highest growth? Does anyone have comments?
The TPP, is that what you're asking?
The Cptpp. So that is the Comprehensive and Progressive Agreement for Trans-Pacific Partnership. That's the new trading grounds.
I defer. I defer.
I haven't had a good look at that. I would say it's probably a little early to tell. I think the biggest drivers is actual production and demand conditions within the countries. That's and that drives food demand. And if India has a short crop, they're going to import. If they've got a big crop, they're going to import less. So I think it might be hard to pick grains out of that in the short run. In the longer run, I have no doubt that it's going to make a difference.
Yeah, I'll just add that I don't know that it was as important, or like our trade relations with China and Japan in terms of tonnages moved with canola and wheat. Those two are very big, and that some of the other players in that agreement are not as important to us, at least not yet. But they might be for potential growth. When we had trouble with China on canola side, we actually went east. Like, the expansion didn't happen into some of these other markets. So I think they're not big need for the commodity that we have. But generally, free trade's pretty important to us, given that amount that we're exporting.
Absolutely. And while we're kind of staying on the topic of China and canola, a follow-up question here. China's actions in 2019 with canola show that non-tariff barriers can disrupt trade. What steps should Canada be taking to mitigate these risks? Would more robust traceability from field to port be part of the answer?
Okay, I'll say that I think we're still in a bulk situation. Like, it's still so much more efficient to move by bulk, and we've just talked about the investments they've made in these high throughput, high efficiency cars and high throughput terminals. So I do think that that's still kind of the main model. That being said, you can put them in containers and move them, and some of our specialty crops do move that way. Some of our organic crops move that way, and so there's a market that's working there. But in terms of solving the problem we had with China, I don't think that's really the solution. I don't think we can IP it through the entire supply chain right now, not be as competitive. Like for me, that I'm still concerned that the cost between that world price and what the farmer gets is low, and all that IP would cost a lot, probably more than would benefit the farmer at the end if they're not growing something like organic wheat.
One of the things that I hear from people in the marketing groups at the grain companies when it comes to IP and traceability is that when this all started as a concept a number of years ago, people thought that there would be a value that you could place on IP and traceability. But what quickly became apparent is that in the cases where it was starting to be used, it became the norm. And therefore, there was no incremental value that you could attribute to the traceability. And so it all started to revert back. There are certain products where you have to have identity preservation and traceability. Two that I would think of right off the top of my head is Warburton's, for instance, the grain that's associated with that, as well as some of the malt barley that's going into some of the specialty brewing. But again, what happened in those cases is that it very quickly became the norm, and therefore there was no identifiable incremental benefit or value that could be put towards it. So people kind of steer away from it.
I guess if I could just add that as private supply chains and companies still have the option to develop their own traceability systems if in fact it pays. And so it's not necessarily something that's a matter of policy rather than just a commercial practice that someone might decide to develop. So I think we have a system now where there are certainly some segments that do trade under identity preservation, but to apply it universally is probably not worthwhile.
And speaking of things changing, we have a question coming in here that says, do you see biodiesel / renewable diesel production as a disruptor to the grain supply chain in Canada, shifting demand to the US for oilseed products? Do any of you guys see that as an issue?
Actually, biodiesel has been one of the big drivers, I think, for canola in general in Canada, and certainly palm oil. China is also committed to more renewable fuels, so I think that makes a difference. These are all good news stories from a demand perspective. I don't think it'll disrupt agriculture. It might make it a little more profitable in the short run, but I don't see a threat from it.
Same.
And another question here says, we're kind of shifting gears a bit. You mentioned consolidation of the elevator system over the years. Is there any incentive for private ownership of smaller parts of the system to help products get to the larger elevators? What activity have we seen over the years? Does anyone have comments?
I'll start. One of the functions of an elevation collection system in the country in particular requires that you have to have the ability to market the product that you're buying or collecting at the origin point. And there's been a few cases where private entities have tried to get into the game and act as a sort of service provider. And more often than not, they fail because they don't have that complete market. And they're trying to compete against large grain companies, for instance, that really are vertically integrated. And that vertical integration really gives them the advantage competitively and economically. And that's where you run into a problem. The few cases where it's worked is because the entity that is going in and has the intention of becoming a service provider, they have a relationship with another larger company that is vertically integrated. I think that's one of the big issues that we see. Short line railways are a good example. they all have relationships with the two major railways, and it's what gives them the advantage. If they were to try and operate independently, they probably wouldn't last very long.
Richard or Derek, do you have any comments you'd like to provide?
Just in terms of producer-farmer delivery, I think more and more so farmers are, a lot more grain is moved from farms in larger and larger trucks and B trains where it can move a greater distance. So the transaction costs involved in delivering locally and reloading that to a larger facility wouldn't make a lot of sense either. So I think there's the economics are very much driving it towards these larger inland terminals that are owned by the land companies.
Well, two things. One is I do know some private sector folks that have bought these elevators and used them, but they're not really part of the export market. Like they're using that facility because it's got access to the railway, and they can maybe use the railway to move somewhere in domestic or US markets. But in terms of, moving to export position to another terminal, you're loading up 50,000 ton vessels, and you need a pretty big network to be part of the team. And so that's why you have to form those partnerships that Mark was talking about. You can be part of the delivery system, so you're kind of, some of the short lines are just reducing their own trucking costs that way. But I think in terms of meeting that Southeast Asia demand, you really have to be part of those vertically integrated grain companies.
Absolutely. So we do have time for a couple more questions here, so keep them coming in. I'm going to address another one. It says, we have had a few recent winters where oil transport has competed heavily for other product space. What are your comments on the future competition for that space, again, from oil, especially when we consider grain volumes are forecast to continue to increase?
I'll take a shot at it to start if you like.
Yeah.
A couple of things about oil by rail. As you saw on the graphs that both Richard and I put up, the preponderance of Canadian grain is starting to move towards the West Coast. And right now, from a directional point of view, the vast majority of oil is moving east and south. Grain is moving predominantly west. And because of that, the only place where you see any kind of competition really for the railway's resources is right at the origin, and that's really not a big part of it. So I think it's a little bit misleading to say that there's been a huge competition between grain and oil by rail for getting railways attention and the resources for that. One area of concern that I think is being raised lately, and it's something that bears consideration, is with the loss of the Keystone XL pipeline, that could have an effect on some of our grain exports into the United States, which are growing and are significant. It's over 10 million to 12 million tons a year. I think where grain competes with other railway traffic, it's in with the other bulk commodities, and most predominantly the container / intermodal movements that come off the West Coast. That's where grain is really competing with for railway resources. And I think that is an area that is growing, and that's something that we should probably have more focus on as an issue for the grain industry. And the downside for grain is that grain is a very captive market. We talk about duopolies, but in fact, when you look at it, it's two monopolies that are moving it. And with the dependence that grain has on the rail network, it's not as competitive. Intermodal and container business is highly competitive. They're competing with trucks, they're competing with other ports. And so that makes it really not a balanced playing field. I don't know whether Derek or Richard.
Well, yeah, I agree with your point, and I think it's the one thing with the MRE that, you know, if competition for movement through Vancouver starts to get so high that we can't afford it, you know, we would have to start investing in capacity changes somehow so that you do compete, or we design the entire thing to move through new ports. But in terms of the basic movements, like Mark, if I understand the way cars are allocated, once the crop is known, the grain companies they're figuring out the railways are figuring out their intermodal plans and their plans to move oil and coal and all those things. And they give the grain companies a plan that they sort of stick to, unless there's some kind of problem with a part of the infrastructure. That's sort of how it works, right? Like
On paper, it does. And what we've seen this year, and when we're comparing what their capacity plan is in comparison to what they actually move, they've actually, in the last 4 months in particular, they've exceeded what their capacity plan that they gave to the industry was. But if you look at the last 4 years, the vast majority of the time, they're not making, their actual movements are not equal to what the actual capacity plan has been. Now, this may change going forward, and I think we're into a new realm right now, and it's going to become a different discussion than what we've seen in the past. But you know, the thing that I think that people have to bear in mind is that it's not about the price you pay anymore. It's about whether or not you are competitive or whether you're not competitive, because it goes back to what you were saying earlier, is that sometimes it's not about the money, it's about the volume.
Yeah.
I guess I'd add one thing to that. It's a bit of a diversion, but it's really important that we know how large that crop is. And a few times we've actually run into trouble where the railway plans have not been nearly aggressive enough. And I guess it's one of my pet peeves that we've got a multi-billion-dollar industry and we've got nobody that's actually on the ground doing really careful production forecasts. And if there was a policy to implement, I would think that would be one that we should actually do. Let's hire some agrologists, let's get them in the fields, and let's get really accurate production forecasts rather than figure out 4 months after harvest that the crop's bigger than we thought.
The other, and to be fair too, the railway, you have to remember that railways have to do their plans anywhere between 9 and 12 months. You can't flip a switch and increase the capacity of a railway. They need a long time to build up the resources, the staff, the locomotives, everything that's required to move for that. So if you find out in July that you're going to have a huge crop coming off in September, it's really too late. The railways are going to take until the next spring to get themselves geared up with proper amount of capacity to move it. So it's a bit of a mug's game.
Mm-hmm.
So I think we have time for one more question here. This is kind of a long one. Hear me out, but I think it's a worthwhile question. So it says, while the growth potential for grains and oilseeds exports is still very good, the potential for dairy, beef, and pork exports is far greater. For example, New Zealand has grown dairy exports from 2 billion to 1990 to 20 billion 30 years later. All three sectors are hindered by regulations similar to the former Crow rate and CWB restrictions, namely supply management and a lack of high-intensity livestock zoning. Any panelists want to tackle the frustration of these multi-billion-dollar opportunities?
Okay, I'll take a shot at it. First off, we're not sure. With supply management, we're setting prices to the consumer, and then setting quota that meets that. But if we completely removed supply management, we might get a bunch of exports from Wisconsin. Like, we're not sure that we'll have excess capacity on milk. On beef and pork, there's nothing restricting us right now. Like that's not really a concern. And it's, well, to the extent that the dairy industries may be bigger than it should be, we might have excess beef that we could sell from those culls. But I think, you know, supply management could be hurting our exports on chicken. Where if we're creating a lot of feed grains for beef and pork, then chicken might be something that we export, or eggs. But we're not sure. Like there could be, you know, there are economies of scale in some of those production systems, and some of these big firms in close to the border might be the ones that take over. So I'm not sure we can say which way the trade's going to flow on those.
Absolutely. Go ahead.
Yeah, I just add that if you look at the mix of crops we actually produce in Western Canada, we've shifted away from a lot of feed grains towards higher value canola and wheat and other things. So I'm not sure that our comparative advantage is in feed grains or in feed livestock, but you know, that's another issue for another day, well beyond what we can do today. But it's not apparent to me that we'd become a world superpower in any of those commodities.
Absolutely. So moving a bit, the Port of Churchill does not seem to get any traffic. Is that because it is inefficient, or is it because the facilities / rail line to Churchill is down? Do you have any comments on that?
Well, the rail line is not down. The rail line is up there and running, and I think this comes back to an earlier question that really needs to be emphasized is that for the longest time, the Port of Churchill and the elevator there was being operated and owned by a company that did not have a country gathering system. So in the recent few years, it's been taken over and it's being operated by a company that does. And so the traffic that runs through that facility is traffic that's being sold by the company that is operating the terminal, which is Alliance Grain Traders. The second thing, though, that I would point out is that it's a high cost operation. If you want to take a vessel into the Port of Churchill, you have to have more insurance. You have to have a vessel that has double and triple hulls because of the ice flows. And it takes longer to get traffic up there than it does to, say, a Thunder Bay or a Prince Rupert or a Vancouver. And it's only open for 2 or 3 months out of the year. So anything that's moving through the Port of Churchill fundamentally is from the last crop year. So, you know, in a year like this, where we could conceivably be getting down fairly low in our stocks by the time Churchill is starting to run, you know, the availability of traffic to be exported through that port is going to be a lot slimmer than what it normally would be. And that's been some of the challenges that Churchill has had. So in summary, you don't have a big grain company operating the terminal. It's a high cost operation, and it only operates 3 months out of the year.
Richard or Derek, do you have any further comments on that? No? Okay. Before I let you guys go, just going to quickly ask if any of you guys have any closing remarks you'd like to make before we close off the live stream.
I just wanted to put one thing out there that I really think that the cost of quota is obscene. I just wanted to make that point. I don't think we should have that. But other than that, I would like to say that I think the MRE was a pretty good policy idea. And I think it's something that could be explored. It's this balance between market incentives and some level of regulation that we should look at as a solution sometimes, rather than hammering it home with a fixed rate that got made up in the 1800s and we stuck to.
Absolutely. Richard or Mark, do you have any closing remarks you'd like to make?
I would.
I guess I'd like to.
Go ahead, Richard. Sorry.
I'd just like to, thank the organizers. This has been a good discussion, and it's a very important part of our infrastructure to think about. And I congratulate them for having this topic, and I hope we talk about it again.
I was going to say the same. I thank you for the opportunity, and I've found this to be an interesting discussion as well.
Great, and thank all three of you for being a part of the panel. Having these discussions is, like you said, it's very important, and it's nice to be able to have experts like yourselves on to talk and to answer questions. And thank you very much to our audience who was in here and asked all these great questions and participated. It makes these live participating things a lot more interesting. So thank you very much. And if anyone just joined us halfway through, you will get the link in an email with the recording if you registered for this. So you will be able to access this afterwards. And once again, thank you all for your insight today, and thank you very much.
Thank you.
Thank you. Bye-bye.